What is zero DTE? When the market opens each morning, most traders think in days, weeks, or months. Long-term investors think in years. Swing traders look for setups that might take several days to unfold. Even active day traders sometimes let positions run overnight. But a fast-growing segment of the market works on a completely different timeline. A timeline measured in hours, or sometimes even minutes. For these traders, everything begins at the opening bell and ends the moment the closing bell rings. There is no carrying risk into tomorrow. Every decision must be made within a single trading session. This is the world of zero-days-to-expiration options, better known as zero DTE. Over the past few years, zero DTE has gone from a niche tool used mainly by institutional desks to one of the largest and fastest growing trading products in the global options market. On certain days, more than 9 million zero DTE contracts trade hands. That's more volume than many entire stock exchanges. So what exactly is zero DTE? Why has it become so popular? And why is it changing the way traders interact with the S&P 500, the Nasdaq, and other major indices? Let's break it down clearly and simply. What zero DTE means. Zero DTE stands for 0 days to expiration. That means the option expires today, not tomorrow, not next week. When the closing bell rings, the contract must settle. For products like SPX, NDX, and RUT, settlement is in cash. For ETFs like SPY, QQQ, and IWM, the option converts directly into shares if it's in the money. There is no extra day of time value. There is no, I'll wait and see what happens tomorrow. Everything must be completed today. Before 2022, SPX options expired on Monday, Wednesday, and Friday. Then the CBOE added Tuesday and Thursday expirations, creating 5-day-a-week expirations. This simple change had a huge effect on the market. Institutions began using zero DTE to hedge intraday portfolio risk. Market makers adjusted hedges more aggressively because gamma exposure concentrated at the front of the curve. Hedge funds developed volatility-based models around same-day expirations. Retail traders discovered daily premium strategies. Liquidity surged, and spreads tightened. Today, every day is an expiration day, and the market looks very different because of it. Why zero DTE is attractive: the power of time decay. One of the biggest reasons traders use zero DTE is time decay, also known as theta. All options lose value as time passes. But time decay accelerates as expiration gets closer. For a weekly option, this decay happens steadily over several days. But for a zero DTE option, all of the remaining time value disappears within a matter of hours. This is extremely powerful for traders who sell premium. In fact, if volatility stays stable, selling one zero DTE option each day, Monday through Friday, can often generate more total premium than selling a single weekly option and holding it for the full week. You are repeatedly harvesting the steepest part of the time decay curve. This is one of the core ideas behind zero DTE income strategies. Capture fast, predictable time decay over and over again. But time decay is only the first part of the story. The statistical edge behind zero DTE. The second key advantage is probability. Over the last 30 years, the daily movement of the S&P 500 has stayed within its implied volatility range roughly 85% to 90% of the time. In other words, the options market often predicts more movement than the market actually delivers. For short-duration strategies, this creates a statistical edge. Many successful zero DTE approaches, iron condors, credit spreads, butterflies, delta-neutral systems, do not depend on predicting market direction. Instead, they rely on the statistical behavior of intraday price movement. Even on trending days, the S&P 500 spends most of its time inside a defined range. That range can be priced, modeled, and traded. Zero DTE lets traders apply that edge every day, instead of once a week or once a month. Who trades zero DTE? Today's zero DTE market is extremely diverse. Market makers hedge constantly to remain gamma neutral. Their hedging flows sometimes move the market intraday. Hedge funds run automated volatility systems. Some hedge dynamically throughout the day, others trade probability-based premium strategies. Large institutions use zero-DTE as a precise intraday hedge for futures or ETF positions. Retail traders participate using defined risk spreads, same-day covered calls, directional lottos, or systematic premium strategies. And high-frequency trading firms look for tiny mispricings in option skew, volatility, and order flow. All these participants together create one of the deepest and most liquid markets in the world. That liquidity is a huge advantage. Tight bid-ask spreads and fast execution make zero-DTE efficient even for small accounts. The risks: why zero-DTE is not for everyone. For all its benefits, zero-DTE can be dangerous for undisciplined traders. The compressed time window means errors are punished quickly. A bad entry or an unexpected move can turn into a large loss within minutes. Here are the most important risks to understand. Volatility spikes can instantly push price outside expected ranges. Major economic data, Fed comments, or unexpected news can all cause significant intraday swings. Gamma exposure increases near expiration. This makes delta change faster, and P/L can swing aggressively even with relatively small moves in the underlying. Oversizing positions is one of the biggest mistakes new traders make. Because zero-DTE trades feel small, many traders place positions that are too large relative to their account. Psychology is another challenge. The countdown clock creates constant pressure. Many traders lose not because the strategy is bad, but because they react emotionally. And selling undefined risk positions can be catastrophic if the market moves far outside expectations. Successful zero-DTE traders follow strict principles: focus on risk before profit, use defined risk structures, keep positions small, avoid trading during major events, think in probabilities rather than predictions, and stick to rules with absolute discipline. Zero-DTE rewards consistency and punishes impulsiveness. Why zero-DTE works? When you put everything together, zero-DTE works for three main reasons. First, time decay is extremely fast near expiration. Second, implied volatility tends to overestimate actual movement, creating a statistical advantage for premium sellers. Third, liquidity is extremely deep, making execution efficient and allowing strategies to be repeated every day. These three forces combine to create a uniquely attractive environment for short-term, rules-based trading. What's next for zero-DTE? We are still in the early stages of the zero-DTE era. As technology improves, traders are developing automated hedging systems, volatility trigger stop frameworks, intraday trend filter models, gamma scalping workflows, skew-based selling strategies, and hybrid directional plus premium approaches. Zero-DTE is not a gimmick. It's a structural shift in how modern markets operate. And its influence will continue to grow. Conclusion. In upcoming videos, we'll dive deeper into intraday market behavior, volatility regimes, gamma effects, settlement differences between SPX and SPY, rule-based zero-DTE systems, and the biggest mistakes new traders make. If you want clear, research-driven insights into how zero-DTE truly works, without hype, you're in the right place. Thanks for watching. New zero-DTE content is coming every week.